Hello, everyone. My name is Nicole Johnson-Barnes, research analyst covering global equities. And the title of my session is So Many Risks, So Little Time, What's Next in Global Risk? And in this chat, I will detail several of the major global risks impacting markets as we head into 2020. And as you can tell from the title, there's a lot to cover in the 15 minutes or so that I have with you. So let's jump straight into it. In terms of the agenda, I'll begin by providing an overview of the current global outlook and then drill into the main areas of geopolitical and economic uncertainty with our allies in the developed East, our neighbors to the West, and within our borders. I'll conclude by sharing my thoughts on how markets may respond to these unresolved concerns and with a not so subtle reminder of the golden portfolio management rule. Before diving into the current state of the economy, let's take a brief trip down memory lane to the end of 2018. If you can remember, the S&P 500 dropped 13.5% in the fourth quarter. Contentious trade talks between the U.S. and China were growing larger and prickly. Brexit negotiations were far from settled with the looming March 29th deadline. And globally, there was a marked reduction in economic activity. While equity markets have broadly rallied back from last year's meltdown, underlying financial signals continue to point to an economic lull. As shown, the OECD's 2019 GDP growth estimates have become increasingly pessimistic. In May 2018, their outlook for the 44 countries studied was fairly positive, with roughly 80% projected to experience expanding GDP growth. A year later, their forecasts were drastically scaled back, with only 5 countries anticipated to end 2019 with accretive growth. These weakened estimates can be attributed to the sustained high level of economic and political uncertainty, which has caused major components of GDP, net exports, business investment, and even personal consumption to tread lower. One of the more telltale signs of a slowing economy is a decline in manufacturing. And anecdotally, since mid-2018, the narrative from producers around the world has been slowing demand, delaying of capital investment, and trepidation about passing tariff costs onto their consumers. And as you can see in the chart, which shows historical manufacturing PMIs for developed markets, emerging markets, and the aggregate global market, up until 2018, manufacturing was expanding, led by month-over-month increases in new orders and new exports. However, since then, the overall trend has been downward and weakening. The global composite now sits below the contraction threshold, as there have been successive declines in the PMI score since April 2018. And as these indications of a decelerating business cycle, slackened manufacturing, and intensifying trade war carry forward, we eventually turn to the rising beacon of insight, wisdom, and non-fake news. Twitter. Yes, Twitter. With growing pockets of financial and civil anxiety throughout the world, Twitter became a barometer for market volatility. There were more tweets on monetary policy, protests, and political posturing than the usual celebrity rants. And what's behind those chirps are several of the global risks that I'll touch on today. Starting with difficulties in Europe, I'll focus my comments here on the 2 Eurozone elephants in the room, Brexit, of course, and the sputtering Germany economy. And in preparation for today's talk, and more aptly as required to earn my paycheck, I took a 10-day business trip to Edinburgh and London to complete on-site meetings with 7 of our UK-based asset managers. While bouncing from meeting to meeting and knocking back cup after cup of English breakfast tea, I was able to engage in several conversations on Brexit. A common theme emerged from those exchanges, that folks, Scottish and English alike, were generally tired of the never-ending Brexit story and desperate for some sort of closure. On a slide, you'll see a few of the safe-for-work comments I gathered from Londoners, a Scotsman, and a rather frank cabbie that I likely annoyed by my multiple requests for him to repeat himself. Their general disdain is best summed up by the top quote from Baroness Lucy Neville-Roth, who I met while touring the House of Commons. Delay and indecision is costly and corrosive. Confirming those observations, UK business and consumer confidence indicators are showing signs of apprehension amongst the Brits. I'm sure you've all heard of the phrase, keep calm, and carry on. Well, the data shown suggests they've been keeping more fidgety than calm this year. UK business sentiment has plummeted as companies brace for the worst case no deal scenario. In an attempt to carry on, UK consumers appear to be vacillating around the neutral mark, showing declining confidence as the first Brexit deadline approached, and then regaining some strength with the announcement of the October 31st extension. What's causing businesses to pull back and making UK consumers nervous Nellies has been both the increasing likelihood of a no-deal Brexit and the potential short and long-term consequences of losing single market access with the European Union. While chances of a no-deal conclusion have decreased with Parliament's recent bill, the now published Yellowhammer report details a laundry list of negative economic and social costs that would be triggered by a hard exit. The map shown provides context on the United Kingdom's interdependence on the rest of the European Union. Britain's major trading partner, as you would expect, constituting more than half of its imports, is the European Union, with Germany being its top supplier of goods. Switching gears to Germany, in August we learned that quarterly GDP for Europe's largest economy registered a negative 0.1% growth rate in the second quarter. Business climate within Germany has climbed to levels not seen since 2012. There's been monthly declines in the German manufacturing PMI since the start of 2019, with the August reading dangerously close to a 7-year low. These factors, amongst others, further strengthen the widespread expectation that third quarter GDP will be negative. And if so, it would mark the second consecutive quarterly contraction, meaning the German economy could potentially be in a technical recession this year. And similar to the Dunkin' Donuts slogan, the German economy runs on exports, particularly the production and delivery of automobiles, automotive parts, heavy machinery, and chemicals. And according to the World Bank, net exports made up 47% of German GDP in 2018. When global trade tensions are high, as they are today, the resulting slowdown in demand has material repercussions on export-driven economies like Germany. In particular, we've seen the German auto industry slump, with BMW stock moving to double-digit lows. The automotive industry is Germany's largest industrial sector, and roughly 78% of cars produced in Germany in 2018 were destined for international markets. Okay, let's turn our attention to Asia. In lightning round fashion, I'll hit on the key quandaries within China, specifically the ongoing trade dispute and burgeoning protests within its borders. I'll also touch on the brewing middleweight fight between Japan and South Korea. U.S.-China trade negotiations show no current signs of subsiding, and I think we are all mentally worn out by the repeated tit-for-tat rhetoric, often followed by an exaggerated shift in the market. And as you can see, the latest round brings total tariffs on China to a whopping $600 billion. And as more tariffs are threatened, U.S. consumers ultimately feel the pinch. With each list iteration, more products are being included that affect our daily lives. And while I vaguely know that a catalytic converter is an essential part of our 2003 Jetta's exhaust system, and yes, we're driving an antique, a 25% increase wouldn't really play into our monthly budgeting so long as the car is still running. However, I love seafood, cooking with garlic, and generally wear clothing made from woven fabrics. And given the rate at which my dog Henry dismantles stuffed, squeaky toys, that 25% increase will likely sting a little if imposed during the holidays. Looking beyond soybeans and the pending tariffs, one of the major sticking points in these trade negotiations has been China's habitual disregard of intellectual property protections. For instance, in January, we learned of a U.S. government indictment against Huawei, a Chinese telecom device producer. Huawei was accused of stealing trade secrets from T-Mobile after being refused the right to license Tappy, a robotic arm used to test mobile devices. This isn't the first time a U.S. firm has accused a Chinese firm of IP theft. Multinational firms like GE, IBM, and Apple have also reported and pursued cases, and it's estimated that Chinese IP shoplifting costs American companies $600 billion annually. Meanwhile, China has mounting issues within its border when it comes to civil unrest in its crown jewel, Hong Kong. The anti-extradition bill movement was formed in response to the introduction of the Fugitive Offenders Amendment, which would allow for extradition of criminals to mainland China, undermining the autonomy of the region and Hong Kongese civil liberties. On the slide above, you can see a couple photos from these massive protests. This past Sunday, September 29th, marked the 17th consecutive week of demonstrations. And as we are starting to see the effects of this unrest in financial markets, with Hong Kong's Hang Seng Index falling nearly 15% since the start of the protest. Macau casinos and luxury brands are also feeling the pain, as it is much harder for their Chinese customers to get to the slot machine or purchase a new Gucci bag when there are tens of thousands of protesters standing in their way. Another growing concern is the deteriorating trade relationship between Japan and South Korea. The standoff between the two nations started in July, when Tokyo placed tighter controls on exports of 3 chemical materials to South Korea. The materials, which are used to make computer chips, are vital to Samsung and other South Korean companies that make semiconductors. Given that South Korea is Japan's third largest trading partner, buying nearly $54 billion worth of Japanese goods, this escalating feud adds to the elevated levels and layers of trade dysfunction in the region and expands the wave of protectionist tactics. And you can see initial reverberations in both countries' local index performance. What's shown is the price return of Japan's Nikkei index, Korea's composite stock price index, and 2 of Korea's largest semiconductor companies, LG and Samsung. There has been negative trend in performance since mid-July for all 4 measures, with LG and Samsung largely feeling the brunt of supply chain delays. All right, let's move on to potentially the largest stronghold of market uneasiness, the United States. While I've spent most of this talk describing areas of concern internationally, I would be remiss if I didn't chronicle the macro and political pressures weighing on our economy. And the list of uncertainties just continues to grow and grow. Manufacturing PMI fell below 50 in August, the lowest reading in 3 years. The yield curve inverted twice in the same month. New York Fed is calling for a potential recession in the next 12 months. Trade negotiations with China are far from finalized, with the White House broadening its scope to capital controls last week, and our commander-in-chief just simply refuses to give his Twitter fingers a rest. In closing, there are no overnight solutions to the risk outlined today, and markets will remain choppy until resolutions are put in place. If Brexit is ironed out by October 31st with an amicable trade and customs deal, I would expect the pound to stabilize as the UK charts a path forward. And if there is a tiny, small slither of a trade deal brokered between the US and China by year-end, markets should respond favorably. While the short-term volatility caused by these events will keep churning out headline buzz, it is important to remember that short-term market corrections will have little bearing on your long-term portfolio performance. So hold tight to your strategic asset allocations, remain diversified, and ignore the tweets. Thanks so much for your time.